Momentum brings momentum. I say it all the time, and just like it does to the upside, it works the exact same way to the downside. And we saw this on full display on Friday with Nvidia. We saw peak to trough intraday drawdowns of 12% in the semiconductor, dragging the entire market down with it. Now, will this downside continue? Today, we answer that question and cover everything about momentum. We're going to be looking at seasonality, what we can expect, and also when normally does momentum peak. The greatest momentum market of our time was 1999. There are a lot of similarities, so let's compare the pair. We're also going to be talking about big money. Are they bullish or are they bearish? We have a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. And what a wild day of trade. Quite a lot of sectors and stocks in the green, semiconductors deep in the red. At one point Nvidia was up nearly 4%. Crazy day of trade, but that's the volatility you get when you are in a momentum based market. We saw financials par a little bit of yesterday's losses, slightly in the green all in all, but we saw more cyclical sectors outperform more than sensitive ones. We also saw real estate outperform, but the market wasn't really getting defensive. Sure, you had outperformance in utilities and this section here in consumer defensives. It was mixed in the bigger names of consumer defensives, and healthcare didn't do so well. So again, a lot of this trade wasn't defensive based, it was just momentum based. The stocks that were leading the momentum charge in the last 4 to 8 weeks were down, as you can see, and the laggards, Apple, Google, they outperformed. Now the S&P 500 was down negative 0.65% today. The Nasdaq was down 1.16%, and there was a lot on the macro front. The US added 275,000 non-farm jobs. The employment rate rose to 3.9%, and this actually had a lot to do with the revisions we saw in December and January. They are now down 167,000, lower than previously reported. And this was mixed data. You know, we got like huge revisions here, good employment data here, and then with Nvidia's flows to the downside, that's why we had the major indices finish red for the day. Now let's hop on the charts. Now in yesterday's video, I showed you the performance of my portfolios, my undervalued portfolio, my top picks portfolio. A lot of you have been asking for a way to track the performance of these portfolios, so I actually went ahead and created this right here. These two links, you can actually go ahead and click it. You will see the portfolio, the top picks portfolio, the performance in real time, as well as performance metrics against the S&P 500, as well as the simulated holdings, how it works, what's in it. You guys can all go have a look at this and track the performance. I have one for the top picks portfolio and the undervalued portfolio. Now guys, today we are just going to look at the S&P 500. In tomorrow's video, we're going to look at mid caps, small caps. This will just be my key levels and outlook for the S&P 500. Now this is the weekly chart looking at candle location and structure. This candle right here, it's called a long leg doji. There's just a lot of indecision to the downside as well as the upside. Neither the bulls nor bears won, but we'll give a slight tick to the bears because it is a red bodied candle. That being said, what we did see was an equal low formed right here. If you want to split hairs, you could say a slightly lower equal low, but I think inconsequential nonetheless, especially considering this momentum. Looking at the chart, zooming out, we can actually see we are still in an uptrend, having put in lows right here and then higher highs at the same time, with an all-time high made just yesterday. At the end of the day, even though sellers did come in right here at the top and take us lower, we did go ahead and make an all-time high, and that is bullish. Now, on a weekly chart, I remain extremely bullish as long as we're above this 4,800 level. Why? And I've said this so many times, simply because this was the level where we made that all-time high in 2021. So on a weekly chart, we could pull back to the top of this zone right here. We can even pull back to as far as this level right here and still be in a technical uptrend. There'll be no technical damage on the chart. So we can pull back to this level, we can pull back to this level, move higher and still be in a technical uptrend. And at the same time, you have to realize that that's actually a pretty significant pullback when you look at it. It's upward of 8.2%, about 6% on the high end. And we could pull back that much and still be in a technical uptrend. It does get a bit grim if we do go ahead and break below the 47.06 level. Then we could really see downside flows move very, very quickly in the favor of the bears. But on the weekly chart, until we actually break these levels convincingly, and I mean a weekly close below, sustained price action below, and I would just look at everything as dip buying opportunities. Now, looking at the daily chart, zooming in, we can actually see a couple of things. A lot of the downside flows we saw for the week happened on Friday, and we're going to talk about why in the video. It mostly had to do with technology As you can see, the Nasdaq down 1.53% here for the most part. That being said, the rest of the week was pretty average. We had a very good day on Thursday. Then we actually had a very trepid week early in the week. Buyers came in at the lows right here and took us all the way up to these highs, and then the flows took us to the downside. Now this is a very ugly looking candle because we closed below the wick low of Thursday, and we actually have a very minimal wick, which means the sellers drove us all the way from the top to the bottom on Friday, and then we actually stayed there. Some bulls did come in a little bit, but I guess inconsequential to be honest. But looking at the 5-minute chart, we actually did have upside flows. Then right here, maybe around 11 o'clock, we saw a huge sell come in. We saw Nvidia led that momentum and flows. Buyers, however, did come in right here. They bought the dip, but then sellers did take us lower, and we actually couldn't break this level right here. And that's going to be a very, very key level to look at into next week. What the bulls are really going to want to do early on in the week is go ahead and capture this level. If we move all the way up to this level and then reject again, that is going to be very bearish. And then we probably go ahead, close this level, close this gap right there. But if we go ahead, break there, above user support, move higher, that is bullish. So 51.50, just call it 51.50 flat, a very key level next week. But let's move back into the daily chart. We're just making new highs every single day, and we actually did that this week as well. We made higher lows all the way to the upside, and it's virtually just been like huge momentum to the upside, very minimal pullbacks. And when we have seen pullbacks, it was just been dip buying opportunities for us to go higher, as you can see right here, right here, right here, and right here. That's a hallmark of a strong market, you know. At the same time, making highs all the way, and we actually did put in an all-time high, not just on Thursday but on Friday too, right at this 5200. So it's very cool to see that we actually rejected at the gamma strike. Okay, we're maybe 9 points below, but at the 5200 level, we do know that dealers would come in a big way and hedge their books right there. How do they hedge their books? They sell S&P 500 futures, and that means they sell S&P 500. Now they do have to unwind, and they unwind by buying, and that's going to lead upside flows into next week, especially into OPEX, the big quarterly OPEX next week. That being said, that's next week's problem, and we do have to look at the key levels right now. So levels I'm looking at into next week, a key level is going to be this level right here. If we pull back all the way to the 50-58 level, let's call it 50-50 flat. So we pull back all the way here, find support, find bullish demand, go up, bullish, make a higher low, we can then go ahead, break all-time highs. If we do go ahead and actually break below this level, I do think we're probably going to see 49.60. I do think the market's going to want to close this gap right here, and we could possibly sell all the way to this area right here. The exact area we're looking at is 49.46. Let's call it 49.50. So next week, bulls have to defend this zone right here, 50.58. If they don't, I think we're going to see 49.50 next week. And that's a pretty vicious sell when you look at it. I mean, from where we are right now to the 49.50 area, that's a 3.4% down week. And it could definitely happen. Don't discount that fact. That being said, we'll take it day by day as it comes, and we want to break above, and we really want to break above the 51.53 level right there. And we don't want to go below the 50.58. If we do, 49.50 will come very, very quickly. That being said, we do want to see this coincide with the gamma call strike moving to the 5100 level. So just a couple of key levels there for you guys in the week ahead. Now, looking at sectors, you can see a semiconductors down 3%. The best performers, real estate, energy, utilities. Now, in the big boys, the drivers of momentum, technology, semiconductors are down. Despite what the rest of the market does, we're going to finish down on the day just because they are the biggest stocks and sectors in the S&P 500. And the truth of the fact is we are in a momentum based market. Now this is momentum factor seasonality. Normally in March, we have a slightly positive return. So we are positive still for March, but in April, we actually see very negative returns, the most negative for the full year. However, given the strength we've seen in the markets for the last 12 to 15 months, and the fact that we are in a technical momentum uptrend backed by favorable fundamentals like earnings, any dip we do get in the market should be looked at as nothing more than a dip buying opportunity until key levels on the weekly and monthly charts are broken and or we get some volatile macro event. Now, looking at sentiment, we actually moved from extreme greed into greed, and that's because we had a lot of downside flows today. We were in extreme greed last week, extreme greed about a month ago, but 1 year ago, we were in neutral neutral. That being said, the hallmark of a bull market is actually being in these extremely bullish, extremely greedy territories. It just means that momentum brings momentum. In this euphoria, what are fund managers doing? And they're still holding equities. This is the NAM exposure index. It just shows how exposed US fund managers are to US equities, and they're sitting at 93.99%. Not the highest levels ever. You can actually get to leverage long up to 200, and we crossed over 100 right here. But as it stands right now, fund managers are heavily exposed to US equities, and this is what they bought this week. So we could see here that total inflows were led by comp services, technology, as well as ETFs. They were the major drivers of flows right here, here, and here. Mild flows into materials, energy, and staples. And then we actually had outflows in financials, discretionary utilities, real estate, and then huge outflows here in healthcare. All in all, we had a total net inflows into equities led by comp services and technology. Now let's have a look at the current state of the market versus the year 2000. I see a lot of people making comparisons, and there's just no comparison. The only comparison you can make is that Microsoft was the top company then, and it is still the top company right now. But let's actually go ahead and look at PE ratio. So, back then, Microsoft was valued at a 60x PE next 12 months. It's now valued at 31x. The second biggest stock, Apple, is at a 25 PE, right? The second biggest stock in 2000 was Cisco at 133 PE. Look at Cisco's margins, 20 times margins, right? Look at Apple's 26 times margin. And the reason why Cisco was so overvalued is simply because the market thought that the internet was going to run on Cisco routers with 50% margins. So the market was pricing in all this growth and margin expansion, and we never ever got that with Cisco. And that's why they had that deep drawdown. But then if we actually have a look at the total, top 10 total divided by the median on both the year 2000 and the year 2024, average PE back then, 42x. Right now, 26x. Average margin back then, 11%. Right now, 28%. That is crazy. Look at the return on equity, 29% versus 25% in the year 2000. And there simply isn't a comparison. We are not in a bubble. We are not overvalued. And all of this right here is backed by huge earnings. That being said, it doesn't mean we can't look for a top. And with all this knowledge, what signals can we look at to form a top? Now, one of the major factors that we could look at is actually just PE ratio. So normally when we get to a trailing PE of close to 30, like we did here in 99, like we did in 2021, currently we're sitting just under 25. Let's just say 25. Right now we're sitting at about 25. We probably want to look for a value closer to 27, 28, 30. That's probably when we'll see a top. Other than that, we could probably see more momentum in this market. Do take into consideration that right here, the Fed injected $1.7 trillion into the market. Now, another indicator we can look at is margin debt. And margin debt is not showing us quite the signals we had here in 2021 and in March 2000. So this is margin financing does not reek of euphoria just yet. This is where we are right now. And what we really want to see along with PE expansion is margin debt shooting to the upside like we did in October 2021. When we see that, we could say a top is coming. We can also look at margins. We could see that margins typically peak more than a year ahead of equities. We do know that we are in a margin expansion cycle, and that is likely to improve when the Fed does cut rates. But when we do see margins decreasing in the S&P 500, we can look at 5 to 11 quarters later. That's when the S&P 500 will likely peak. So in that time, we can look at PEs expanding, we can look at margin debt increasing, and we can ask ourselves, when did margins peak? How long ago did they peak? Is it in between 5 to 11 quarters or 9 to 11 quarters? Yes, it is. Then we could say we are very close to a peak. Until we actually see everything from those signals, we're not close to a peak. And yeah, we will get pullbacks 100%, but we're not going to have major drawdowns like we saw in 2022. Now let's talk seasonality. This is actually very interesting. This is a midterm cycle in a down year and a presidential year against the current S&P 500 price action. So you can see here that based on a presidential year, when Joe Biden got into office right here, we're actually completely underperforming in a normal presidential year. However, in a down midterm year, we're tracking in line with seasonality. What we could actually see is that we still have quite a lot of upside to go, at least if we do follow the seasonal pattern, but we can actually experience a little bit of volatility here and here towards the end of the cycle. That being said, expect more upside and near-term volatility. Looking at gamma. Now guys, I'm not going to go ahead and explain this gamma chart right now. That's going to be in the weekend video. This is still the daily recap video video of Friday. I'm just a bit late to uploading it. 5200 is the call gamma strike. There's still a ton of gamma in the tape right here. I think we're going to see a lot more negative gamma next week after today's flows. That being said, come Monday, we will still be in a positive gamma environment. I think the call gamma strike will still be at 5200. And until you actually see this move down the tape to the 5100 mark right here, buy all dips, sell all rips into higher price action for us to go ahead and touch the 5200, especially before this March quarterly OPEX. Now, next week is OPEX week. We do have to take that into consideration, and Wednesday is VIX-piration, but I'm going to talk about Max Payne and everything in next week's videos. Now, let's have a look at some key important charts. This is the S&P 500 versus the New York Stock Exchange weekly net new highs, new lows. Now we're sitting at 24.1% of stocks at 20-day highs. As you can see in the chart right here, we also have net new highs increasing every single day. Now we did have a thrust right here. And normally when we do have these thrusts, we do go on like long periods of consolidated returns. That's exactly what we saw. So do expect higher price action in the S&P 500. We have actually made a lot of those gains already, but it can go on for a good number of months, even a couple of years, as you can see right here. You know, this was like 18 months for the most part. Now, looking at the percentage of S&P 500 stocks down 10% or more from 52-week highs, that number currently sits at 34%, and the percentage of stocks down 20% or more from 52-week highs is at 13.5%. It's some of the lowest levels it's ever been since we reached the end of that 2021 rally, that massive post-COVID rally. This is what you want to see in a bull market. Now, in a momentum-driven market like we are right now, like we were in 2021, we can actually see these levels stretch even further to the downside. So if you are contrarian, thinking these are going to shift up, I wouldn't hold my breath while the fundamental and the technical picture look so good. Now, this is the S&P 500 sectors above their 50-day moving average. 100% of sectors are above their 50-day moving average. Extremely bullish when you look at these longer term charts. Now, percentage of sectors above their 200-day moving average, 100%. And this right here is a very, very key indicator, because this is the long-term trend, and the long-term trend for now is up. Now, looking at home builders versus the S&P 500, often a barometer for the economy, and you can see here that we are moving up. We broke this resistance turns support right here, and we're moving up. And until you actually see a breakdown of this chart right here, that would signal the economy is not doing too well. Probably means higher price action, and all dips in the market should be just looked as buying opportunities, at least until we break this line right here. Now, looking at some BOFA institutional charts, you know what these are. We look at them every single week. Fund managers look at the exact same charts, and we can see here that this is spot gold on the weekly chart. We can see a bull flag from mid to late 2023 suggests upside to 2369 in 2024. So we got this bull flag right here. A break above 2135 means we probably go to the 2350 level, move up, maybe a bit of a pullback in the near term, and go all the way up. But gold does look very, very bullish right now, especially breaking above these highs and closing above it on strong candle structure. Now, looking at gold on the daily chart, new intraday and daily closing all-time highs. We're mindful of RSI momentum being the most overbought since March 2022. That probably suggests some form of a pullback, but continuation higher, because momentum is on the side of the bulls. Guys, RSI being overbought is not a sell signal. That's actually a bullish signal. It means the momentum is in the market. It just means we could get a near-term pullback to work off some of these overbought conditions. Looking at the US 2s versus 10s, the curve is flattening, approaching key levels at negative 46 basis points and 0.56 basis points. Ideally, the curve does not flatten below negative 56 basis points to maintain a wave 3 steeper conviction rally this year. In other words, we are moving down, but both do expect the yield curve to uninvert at the 0 point right here. What they don't want to see though is the curve moving below this area right here. That being said, both are bullish on rate cuts this year. I do believe they predict 3 rate cuts, and that means the curve will uninvert later this year. Now, looking at the 10-year yield daily charts, these are all yield support levels right here, all of these, and then resistance levels up top at 4.2, 4.34, 4.55. So it really depends. If we go down, you can look at these resistance levels right here and right here for a bounce and an increase in yields. But if we are going to move to the top, we can look at resistance levels right here, and then right here, and then right here. Those are the resistance levels for BOFA. So whichever way you believe yields are going to move, these are the levels that you can look at. But if you've made it up until here, thank you so much for watching, guys. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment. Cheers.